If you're new to investing or have been thinking about investing for a while and have no idea where to start, index funds may be the best option for you. If you pick the right funds and invest consistently, you will surely become a millionaire. When? Well, that depends on how much you contribute towards your investment each month and how long you stay invested. I want to give you an actionable list of my favorite index funds, some of which I personally invest in. Please note that not all of these funds are suitable for all portfolios, so do your own research before you start investing. There is always a risk of loss of capital with any kind of investment. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I have helped dozens of women take control of their financial future. Subscribe to my YouTube channel and follow my Facebook page to get all my latest videos on building your own wealth through investing. In this video, I will explain what index funds are, go over some of the different types of index funds, and finally give you an actionable list of low-cost index funds that may be suitable for some portfolios. Before going into indexed funds, let me go over what an index is. If you are already familiar with this concept, feel free to skip over this part and go directly to the part where I talk about index funds. A market index or an index is a paper portfolio or a hypothetical portfolio that represents the entire market or a segment of a market. This is easier to explain with some examples. The S&P 500 index is a collection of the largest 500 companies listed in the United States. The companies are cap-weighted, which means companies with the highest market capitalization hold the largest weight in the index. Apple, with a market capitalization of $2.8 trillion as of January 2022, has a weight of 7% in the S&P 500. Apple is followed by Microsoft, Amazon, Google or Alphabet, Meta, Nvidia, and Tesla. These 7 companies make up almost 26% of the S&P 500 index. The S&P 500 represents 88% of the investable market in the United States. So if you want to get a general sense of how the economy is doing, instead of looking at individual companies, you can look at this broad market index to get a general sense of the direction of the economy. This is one use of a broad market index. Another use is to evaluate the relative performance of your individual investments over a period of time. A market index serves as a benchmark to assess your relative performance. Say, for example, your investments returned 30% in 1 year. Sounds impressive, right? And it is. However, if the general market returned 50% that same year, your relative performance would be negative 20%. Which does not sound impressive at all, which means that your investments did worse than the market by 20%. Or say your investments returned minus 8% 1 year, which sounds horrible. But if the general market returned minus 10%, your relative performance would have been a positive 2%, which is excellent. There are many different indexes or indices and different index providers. S&P, MSCI, FTSE Russell, NASDAQ, to name a few. S&P 500 is an example of a broad US-based index. There are also cap-weighted indexes or indices. S&P 500 is an example of a large cap-weighted index. S&P 600 is a small cap-weighted index and includes 600 small-cap companies in the US. There are also sector-specific or industry-specific indices. For example, the S&P 500 Energy Index includes all the energy companies from the S&P 500 index. There are also style-based indices that focus on specific styles of investment, such as value, growth, or core, etc. There are regional indices. MSCI EAFE, or the Developed Markets Index, includes companies from 21 countries classified as developed by MSCI. The MSCI Emerging Markets Index includes companies from countries classified as emerging markets by the MSCI. Each index provider has its own inclusion criteria based on which a company may be included or excluded from that specific index. There are also country-based indices such as MSCI Korea Index or MSCI India Index, for example. There are also asset-based indices such as the Bloomberg Barclays US Aggregate Bond Index that includes investment-grade bonds that trade in the US. There are also commodity indices or REIT indices or multi-asset indices. There are also specialized indices such as home price index, crypto index, volatility index, and so on. And if you're wealthy enough, you can also pay an index provider to create a custom index for you. That brings me to the third and very important use of an index, which is the creation of an index fund. In 1975, John Bogle, or Jack as he was well known, came up with a brilliant idea. He created the first index fund. The idea is, instead of paying high fees to try to beat the market, you mimic the market and achieve higher returns through lower fees. You're not making any active decision about which company will perform better than the market. You're investing in every single company that is part of an index in the same exact proportion as it is in the index. The premise is that fund performance may come and go, but costs are forever. And by saving on these costs, an average investor that indexes will outperform an active investor who tries to beat the market over the long run. To understand how costs eat into your performance, watch this video right here. Are you ready to make a list of my favorite index funds? This list is by no means a recommendation for you to invest. Every investment has risk of total loss of capital, so do your own research before you make any investment. Also, just because these funds may be suitable for one portfolio, they may not be suitable for every single portfolio. Go through your own investment policy statement and talk to a professional before you make any decisions to determine the suitability of these investments for your personal investment portfolio. I will talk about investment plan in my next video. There are 4 basic types of funds that I personally invest in. I have them in different types of portfolios. For example, I hold domestic and international stock index funds in both taxable accounts and tax advantaged accounts. And I hold bond funds only in tax advantaged retirement accounts. To learn what those are, check out this video. So are you ready? Let's begin. Let's begin with domestic index funds. If I had a choice of holding just one index fund in all my portfolios, I would choose one of the funds that I'm going to talk about in this section. Number 1, the Vanguard Total Stock Market Index Fund. Goes by the ticker VTSAX. This fund gives you exposure to the entire US equity market. By owning one share of this index fund, you get a piece of almost all companies, large, mid, small, growth, value, etc., listed in the United States. Of course, by owning that one share, you don't get any decision-making power in any of these companies, but if history is any indication, US-based market should grow in the long run, and by owning a broad market index fund, you should be able to participate in this growth. History does not repeat itself, but it often rhymes. If you do decide to invest in this mutual fund, it's better to open a Vanguard account and buy directly through Vanguard because there are no transaction fees. However, if you do decide to use your brokerage account, make sure to check if there are any transaction fees. Vanguard does require that you make an initial investment of at least $3,000. Your subsequent investments may be smaller than that amount, as low as $1. This fund already has about $1 trillion of assets under management. Now, if you're just getting your feet wet or do not have $3,000 to make that initial investment, Vanguard does offer an ETF counterpart that goes by the ticker VTI. As of the day of this recording, VTI was trading at $230. You can buy one or more shares. You can also buy fractional shares on certain platforms. The underlying securities in VTI are almost the same as VTSAX. However, VTSAX is a mutual fund and VTI is an ETF or an exchange traded fund. And if you look at fees, VTSAX charges 4 basis points or 0.04% and VTI charges 3, which is 0.03%. If you invest $10,000 in VTSAX, you will pay a fee of $4, and if you invest in VTI, your fee will be $3. So not much of a difference there either. The performance is also pretty close because the underlying securities are almost the same. You may see day-to-day differences because the ETF trades throughout the day and the mutual fund only trades once a day at the end of day NAV or net asset value. But overall, over the long run, the VTSX mutual fund and the VTI ETF should track pretty closely because they're tracking the same underlying index. The next fund is Fidelity Zero Total Market Index Fund. Goes by the ticker FZROX. This is very similar to the Vanguard VTSAX fund I talked about, and the expense ratio is 0. So essentially you pay no management fee to own this fund. Fidelity does not own a corresponding ETF that matches this index fund, but there are also no minimums to own this fund. The fund has about $13 billion of assets under management. The next one is Schwab Total Stock Market Index Fund, or SWTSX. Again, this fund is very similar to the Vanguard and Fidelity funds I just talked about and has an expense ratio of 3 basis points, no minimums, and has more than $18 billion of assets under management. The next one is iShares Core S&P US Total Stock Market ETF. It goes by the ticker ITOT, and it is very similar to the Vanguard VTI ETF we just talked about. This ETF has an expense ratio of 3 basis points. Next one is the Vanguard 500 Index Fund. It goes by the ticker VFIAX. While VTSAX gives you exposure to almost the entire investable US market, VFIX gives you exposure to large cap companies that are part of the S&P 500 index. This represents more than 80% of the investable US stock market. This fund also has a low expense ratio of 4 basis points or 0.04%, and you can invest directly through Vanguard. There is also a minimum initial investment requirement of $3,000, but you can choose the ETF counterpart of this index fund that goes by the ticker VOO and has a low expense ratio of 3 basis points or 0.03%. Then you also have FXIAX by Fidelity, SWPPX by Schwab, and IVV by iShares. All the funds that I just went over give you exposure to the US domestic stock market index. You don't have to invest in multiple funds. All of these have low expense ratio that do differ by a few basis points and have different minimum requirements. You can choose the one that's most suitable for your portfolio. One advantage of investing directly with the mutual fund is that you can set up automatic investments in the fund. So for example, if you get paid on the 15th of every month, you can set up direct deposit out of your checking account into your Vanguard or Fidelity account and have it directly invested into that index fund for you. This will help you stay consistent with your investments, and you will be less likely to spend the money that you don't see anymore in your checking account. This option of investing automatically is not available with the ETF. If you like what you've heard so far, please smash the like button, and if you haven't already, please subscribe to my channel so you don't miss any of my latest videos. I post a new video every week. Well, almost. And to help you better allocate your income, I have linked my personal budgeting worksheet in the description below, so don't forget to grab that. And if you're watching me on Facebook, don't forget to follow my page. Now let's move on to international stock index funds. Number 1, the Vanguard Total International Stock Index Fund, which goes by the ticker VTIAX. This fund gives you exposure to the whole world except the United States. So if you own any of the funds that I described earlier in the domestic US fund section, this international fund will be a great addition to create a well-diversified portfolio. The fund already has $400 billion of assets under management and charges 11 basis points or 0.11%. Vanguard also requires a minimum initial investment of $3,000 on this fund. If you prefer an ETF instead, Vanguard also has an ETF counterpart for this fund, which goes by the ticker VXUS. It has a lower expense ratio of 0.08% or 8 basis points, but the underlying securities are almost the same. The next one is Fidelity Total International Index Fund, FTIHX. This fund gives you exposure to international markets, both developed and emerging, similar to the Vanguard International Index Fund. This fund has a lower expense ratio of 0.06% and manages about $9 billion. Fidelity also has another international index fund that goes by the ticker FZILX. This fund charges no fees and manages about $3 billion of assets. This fund does not give you any exposure to small cap international companies. It only invests in large and mid cap international companies, which still represents a decent size of the international market, about 85% of the total international investable market. The next one is the iShares Core MSCI Total International ETF, goes by the ticker IXUS. This is very similar to the Vanguard VXUS and has an expense ratio of 9 basis points or 0.09%. We have been in a low interest rate environment for many years, and you may be tempted to only invest in stocks and ignore bonds entirely. However, bond funds are very important to create a well-diversified portfolio, especially your retirement accounts. So here are two bond funds that you may want to research. The first one is Vanguard Total Bond Market Index Fund, VTBIX. This fund gives you exposure to US-based investment-grade bonds and has an expense ratio of 9 basis points or 0.09%. And the next one is Vanguard Total International Bond Index Fund, which goes by the ticker VTIIX. This fund gives you an exposure to non-US or international investment-grade bonds and has an expense ratio of 0.13%. If you're invested in these bond funds through your retirement account, you may have access to an institutional share class that has lower fees. The corresponding institutional share class tickers are VTBNX and VTILX. Bonds typically pay out interest income, as do bond funds. Some stocks pay out dividend income, as do stock funds. Not all income is created equal as far as taxes are concerned. Interest income gets taxed at your regular marginal income tax rate. Dividend income can be qualified or non-qualified. Qualified dividends get taxed at a lower tax rate, which is why it makes sense to not own bond funds in your regular taxable brokerage account. However, make sure to talk to your accountant or tax attorney before you go and make any changes to your portfolios. In my next video, I will talk about how you can create your own investment plan similar to an investment policy. It's a very important topic for everyone, whether you are just starting out or you've been investing for a while, whether you're working or you're retired. Everyone who has money needs to have an investment plan. Make sure you subscribe to my channel and hit the bell icon so you don't miss it. That's it from me this week. I'll see you in my next video. In the meantime, as always, don't forget to be happy, to be kind, and to be your best self. Bye! And here are some more videos I think you will enjoy. I would really appreciate you hitting the like button and sharing this video with your friends and family. It will help me reach more people.